Welcome to the stage, Chetan, Trehan and Matthew Hattersley. We need to find out what it takes to rate or to be a superior manager.
Okay, welcome. Hi everybody, lots of familiar faces. Wonderful to see you here today. For those that don't know me, I'm Matt Hattersley and I'm joined here by one of our sector heads, Chetan, who I've now worked with at SQM Research. Well, he was there when I joined. So I've been there 4 years and Chetan's five and a bit, mate. Mm-hmm. Yeah. So what we're going to talk about today, oh good, we can see the slides down here, is we're going to run through an update on who we are at SQM Research, and then certainly just touch on some of the nuances that we have in our business and how our ratings ultimately can be very complementary to those other ratings provided by our peers in the marketplace. So Chetan's got the clicker, or maybe I can do that. We'll work out which one's the right button to press. So there's our deck. Our primary focus at SQM Research is as a rating provider. So we have a very strong rating mission. It's our focus and our sole business when it comes to managed accounts. We do have a business diversifier, but is unrelated to funds management research, and that is our residential property database. But we're here to talk about the rating business. And just as a quick overview and a reminder to you all, SQM, we're now rating around 500 solutions in the marketplace. And earlier you might have noted, I said Chetan's been around 5 and a bit years, myself 4 years. And it's really nice to see how the business has grown since we joined.
Largely because of us, right?
Oh, well, just join the dots. Yeah. That's it. It's an easy one. Now, in terms of that coverage, as I said, we're rating a fairly large number of funds now, complementary to the other providers in the market, but not just complementary in that we rate differentiated funds, but we also rate a lot of the regular funds in the market across all the different asset classes. Now, Chetan, little nuance there on the yellow sector.
Yeah, look, multi-assets about 207 as of a couple of months ago. It does include multiple APR codes and risk profiles in a report, so that does sort of make the number a bit higher. In terms of reports, we're looking at roughly 50 to 60 reports. Some are done separately, but some have 4 or 5 risk profiles in them. And that's grown a fair bit in the last 3 or 4 years.
Yeah, it's certainly, since I've been on board, we've seen, of course, the growth of multi-asset SMAs being used in the marketplace. And as a, rating house that doesn't manage money, we have been, been able to rate those strategies without any conflicts in our operation. Now, as a rating house, and for those of you who are fund managers in the room who, have, of course, have your solutions rated, we have a very defined rating process. One thing I'd ask you, Chetan, at this point, over the last 5.5 years, how have you seen our rating process evolve?
Yeah, look, that's always a good question. It's a small firm which has grown over the years, and therefore the process has grown as well. And I believe it's become more robust in terms of all asset classes, not just multi-assets. And I'm the sector head for not just multi-assets, but also real assets and alternatives. So the process, as you can see on that slide, is fairly involved, right from the initial meeting with the fund manager to see if we should rate that strategy up to the very end. It's a process that does take several months, generally speaking, unless it's an expedited review, if the fund manager wants it within 6 weeks, for example, but on an average, reviews would take 3 to 4 months from step 1 to step 9. And it involves obviously getting the RFIs from the fund manager, the analysts involved, whether they're in my sector or my colleague's sector, would then go through those. We would arrange a meeting, which would be anything between 2 and 3 hours, depending on how familiar we are with the fund manager and the complexities involved. We would then prepare the draft report for the fund manager to look at and do a quant analysis on the side. A parallel step would be sending the draft report and a scorecard, which we will talk about in a minute, to our ratings committee. Ratings committee is a relatively recent addition to the process. Roughly 1 year ago is when we started the ratings committee component. We've got 5 members in the committee, 2 independents included, and myself included within those 5. So the ratings committee votes on all new reviews and ratings, and also any ratings changes, which of course includes upgrades or downgrades. And then once that's approved, and any sort of minor changes to the report needed as per the feedback from the fund manager, not in terms of our opinions, but in terms of factual information, we would amend what's needed and then release the final report and the rating. So yeah, quite an involved process and very robust, I should say.
Thanks. And you mentioned in there the scorecard. So when we look at the next slide here, where we do capture what we look at, where do we focus here in terms of the rating process, and how's that relevant to a multi-asset SMA type portfolio?
Yeah, look, it's the scorecard is a common scorecard for all asset classes, although we are working on a couple of different variants of it, depending on nuances of different asset classes, mortgage trust or private debt, for example, or direct property, for example. But let's stick with the vanilla scorecard. It's 37-point checklist there, as it says, within those 6 factors. So on an average, 4 to 7 factors within each category, in other words. So we score each category, starting with, as it says, governance and business. So the strength of the business matters. The people who are in senior management of that business matter. And obviously the team component is covered under the second part. That's what people is about. So yeah, look, strength of the business, governance processes, if they have independent directors, for example, is there an independent responsible entity or trustee, their experience, all that is considered, and we score those factors within that governance and business component. And of course, compliance is also a factor there. Yeah, if there are any compliance issues, that can lead to a lower rating, obviously, even if other factors score strongly. Yeah, people would be the second category, always important. The team within the funds management business, who are the portfolio managers, assuming they're multiple, and again, the size of the team, experience of the team. And again, in terms of size of the team, it is a bit nuanced, depending on the sector. For some sectors, one portfolio manager might be sufficient. AREITs, for example, 1 PM and an analyst, I'll be fine with that. But for some other sectors, I'll not be fine with that. Depending on that, experience of the team, staff turnover, of course, is another factor. So there are a few factors within that team and people component that we look at. Product features, which, of course, for all the advisors here, are also important, and the end investor for that matter. So includes fee, for example, and also redemption policy, which becomes quite important for certain sectors, especially if they're illiquid assets within the portfolio. Risk and return, obviously very important, and we look at not just absolute returns, but relative returns and information ratios and Sharpe ratios, which always keep researchers excited, those sort of ratios. Philosophy and process, that's generally pretty straightforward in terms of how the fund manager manages their portfolio. Is the process clear enough? Is that being followed as it says? Portfolio construction in terms of how they size those positions, select those positions. And again, there's some nuances across different sectors. Largely, it's based on which sector it is. And in the context of managed accounts, the ratings process would largely be similar to a managed fund in a unitized fund, that is. And all those things matter. Portfolio construction, of course, includes things like concentration risk and other factors which we consider. So that's 37 factors, we score all of them between 1 and 5, and we'll get to the rating scorecard soon. And then once the analyst has done the scorecard, the analyst would have a chat with the sector head, which either myself or the other sector head in our team, which is Paul, and then we would arrive at a rating, and as I was saying, then send it to the ratings committee.
Now, Chetan, we spoke about a lot of those factors there. Do we weight them equally, or are some more important than others?
We have different weights for them because they're not all equal. So the weights would be between 10% and 25% for those 6 categories.
Yeah, and that allows us, of course, to rate newer strategies in the market that might have less performance track record on the individual product, but we will look at the track record of the manager maybe in previous lives, if there is alignment between this new strategy and the older strategy.
Absolutely, and we've always had a good chunk of boutiques and new fund managers launched over the last 10 to 15 years since SQM has been doing that, we do rate the largest managers and also the smallest managers around. So yes, track record is one component. We're happy to consider if that team or individual does have a past track record at another firm and not mark them 0 or 1 on that.
Excellent. Thanks, Chetan. Now, we've got, of course, when it comes to managed accounts, it is an area that we've seen a lot of growth in over the past 3 or 4 years is at SQM, and we continue to see, new products and variant products come to market. How do we consider, and what sort of nuances do we look at when it comes to managed accounts?
Yeah, so most of our coverage in the managed account space is within the SMAs, and therefore that's bullet point number 1. IMAs and MDAs are only a handful of examples in terms of our coverage. I'm sure that will grow, but SMAs is the biggest chunk, and within that, the lion's share is actually multi-asset SMAs rather than Aussie equities or global equities. It has grown a fair bit in the last 3 to 4 years, and as Matt was saying earlier, another good reason is not just that we do cover them, but also we're independent and don't have a big conflict of interest because we don't manage money. And there, in terms of features and the suitability of structure of the investment, we're largely agnostic. As a research house, it's between the client and the advisor to decide whether it's an SMA, unitized fund, SMA, IMA, or MDA. Obviously, there's some features that are different. Execution is different. We do consider all those factors. Implementation and execution, as you know, can lead to a little bit of a slippage in returns. So we've had some SMAs, for example, which have different returns across 2 or 3 different platforms. So it depends when that investment decision was made versus executed. So the client returns can be a bit different. So therefore, advisors and clients need to be aware of those sort of things. Governance can be slightly different as well across different structures. Platforms, of course, have their own REs, so all that needs to be looked at. Fee is always an important one, which, of course, like we mentioned, is part of the scorecard as well. And there's a bit of a fee pressure in the industry, as we all know, especially in the multi-asset space. So what we've noticed is, depending on how actively that portfolio is managed, or passively through index funds, fee has reduced a fair bit over the years, and the lowest fee that I've seen within our coverage is 15 basis points, 1.5. Average is about 50 to 60 basis points, with the higher end being close to 1%. So there's a fair bit of variation. But again, it's not the case that lower fee is always better. Of course, it could be. It depends on clients' requirements again, and alpha you want to achieve. So those sort of discussions. So those are some of the nuances to consider in terms of managed accounts.
Thanks, Chetan. And then just sort of from a final slide perspective, here is just a summary of the ratings table that our outcomes come out at. And certainly, my comment on this is that when, I'm out there talking with the platforms and advice businesses, I think, they all will draw the line in the sand at a level that they're comfortable with, that fits within their process. I don't think there are many of our clients that wholly rely on just an outcome from us in terms of choosing it. They do their own individual assessments alongside the rating and have it as an input into their processes. And so that line varies, but typically it is around probably more the 3.75 to 4-star rating area at a minimum that most advice groups and platforms are actually looking at before it will be accepted, through their processes.
Yeah, and our sales team is more familiar with those sort of requirements. Matt and Peter Evans, for the ones who know him. From a research perspective, we don't obviously target any particular positive rating. It's good if a fund or an SMA achieves that rating, of course. But yeah, we have to be fair, irrespective of what platform rating requirements are. And some ratings unfortunately do not reach that positive 350 or 370 mark. 350 is sort of low investment grade, so not ideal. But it is, for some businesses, that's fine as well. But yeah, anything below that is a bit of a problem. But we do have a few ratings which are below 350, and we do recommend to the fund managers to make a few improvements if they want to see improvements in ratings.
Thanks, Chetan. And just sort of as a final point that I'd like to make before we open up to any questions that you might have, is that one area where we're starting to have a few more discussions is with those dealer groups that are running their own SMAs, because to date, I haven't really seen a huge demand for those sort of solutions to be rated to meet the governance hurdles. Obviously, the underlying component pieces of the portfolios tend to have good ratings from various providers and therefore meet the needs to be hosted, the component solutions hosted on the various platforms. But the actual overarching piece of putting the portfolio together, if you're running your own business to date, hasn't needed it. I think there's starting to be some interest from a number of groups, and we're having some good conversations where, their SMA's reached reasonable scale and they are looking at to be rated. And the three reasons I'm seeing that rating is being sought is firstly to meet some internal governance requirements, just so that they can show to whoever might be asking that the methodology that is used to construct the portfolio that's been used broadly, meets minimum hurdles and therefore is suitable to be used across the network. I think that it's also a way to potentially validate the use of those solutions to the clients, the existing clients of the firm, to actually show that it stacks up relative to similar approaches or similar solutions in the market offered by other providers, that you're getting good quality offer in the market, and the rating does that. And then thirdly, the other thing is that those firms that have reached that scale are often quite, they're looking to expand and acquire bolt-on operations and continue to grow their businesses. And if those solutions that they're looking to bring those new clients into and bring those new advisors on board with has a rating, I also think that it helps the marketability of that internally and to those clients. So they're the three reasons that I'm seeing that interest, and hopefully we'll continue to see the number of multi-asset SMA solutions that we're rating grow, and also that will enable the advisors having that input into their process alongside their set investment philosophy in building their APL, helps them meet their requirements and stay out of the aims, out of the targets of the regulators. So on that note, certainly Chetan and I are happy to answer any questions that you might have about what we've spoken about today.
Questions? Yep.
In terms of the managed accounts, you're probably the industry standard, you rate the most. Is there a reason why you wouldn't get a rating with you guys? Are you finding that maybe they will be on the lower side in the terms of the ratings and they're scared, and that's why they're not getting them rated? And also, what would you say to advisors that are using non-rated managed accounts?
In terms of, going back to the first point in our 9-step sort of rating process that Chetan went through, the reason why managers don't get a rating is that we'll sit down and with a lot of managers, in whatever asset class they're in, and have a conversation with them around our process, what we look at, those 37 points across the 6 categories. And we'll talk about what we like and what we don't like. And a lot of them do a self-assessment at that point and really probably realise that they don't have enough structure or rigour across some of the key categories to really get the sort of rating that you need to be able to, promote their solution into the marketplace to be accepted by the advice professionals, to meet their own, to reach into that process. And so in a lot of cases, they self-select out. We don't have to say, no, we're not going to rate you. Look, we're quite happy to rate someone if they were lower, but we don't think it's a value proposition to, be charging them to do a rating that comes out poorly, because the chance of them coming back is lower because it might not be favourable. So we're quite happy to wait for them to come back in 6 months, in 9 months or 12 months, once they've tweaked those areas that they've identified as being a little bit weaker to help improve their score and getting an outcome that they can use in the marketplace. And certainly I think in terms of, why wouldn't someone get a rating, or those people that don't have a rating, look, I think that, maybe it's a point where I think there appears to be, increasing the regulators are looking more deeply at what people are getting exposure to, particularly in superannuation, as we heard earlier in Rep 779. And I think that getting a rating really helps just show the robust processes and the like that might be in place around the construction of the various portfolios.
How you going? Just with the disclaimer of historical performance is no guide to future performance. Just wondering, have you guys looked at the dispersion between your different ratings historically in regards to performance? So, going from a 4.5 star to a 3.5 star, is there a discernible difference in historical performance, or does it tend to revert pretty close to the mean anyway?
There is a difference that we have seen, although we don't publish that publicly. The other thing I would add is performance is just one component, and therefore not necessarily the most important component, actually, because like our scorecard shows, there are different issues to consider, not just how much risk is being taken, but also the... Sure. Yeah. So look, absolutely, we would generally prefer higher ratings for better performers, absolutely, subject to the fact that the business is strong enough, the governance is strong enough, and things like that, which is where some smaller managers, can I say, or newer managers might not get a very high rating compared to a bigger firm. But yeah, largely it is better ratings for better performance.
And in fact, I'd go the other way, is that the better rated funds do tend to perform better historically. We have seen when we've back tested it and looked at the ratings we've issued, maybe not where we've upgraded them or whatever it might be, but in terms of the absolute ratings, we have seen a trend that the better rated funds have historically performed better.
But it doesn't need to be that way is my main point, because we're not focusing on that result.
Can I ask, I think you said that you were independent, but how does that square with the fact that you're actually receiving a fee from the manager that you're rating?
Sure. So I'll start on that. Independent in the context of not being owned by a large firm, and independent in the context of not managing money. Obviously, we do charge a fee. The fee is charged before a draft report is ready, or a rating is ready. So therefore...
in fact, I go further, sorry for interrupting. If we engage a manager to do the rating and they're a bit slow on the payment of the invoice, we will actually cease working on the rating because we don't want to, potentially do work with no revenue. I don't know how many of you guys, work that way, running a business. But secondly, to minimise that conflict that could exist through people saying, we're not going to pay you until we see the rating, and if we're happy with it, we will cease doing work on a rating until the payment comes in. So it's charged up front. We do have separation between the commercials done by ourselves, myself and my colleague Pete Evans on the sales side, and the research team. The Chetan and his colleagues are not involved on that side of the commercials or the contractual discussions. And once we receive the signed contract from the manager, that's when we let the research team to start to do their research. And then, we look after that commercial side on our side of the building.
Correct.
Okay. Now, I'm pleased to say you must be the most interesting session because there are the most questions. So you get the
Good to hear that.
the chocolate fish. Last question, which is, as I've been judging evaluating the awards entries over the last month or two, I've noticed quite a range of benchmarks within an asset class, some of which struck me as being relatively low hurdles, some of which seemed appropriately challenging. What place does the managed accounts benchmark or objectives place in your assessment of the process and service?
Thank you, Toby. It absolutely is a big discussion point in the risk-return component of our discussions and the scorecard. And yes, some fund managers do keep a low bar in terms of a benchmark in their PDS. We do have to report if there's a formal benchmark in a formal document like PDS, which is regulated by the regulator. Obviously, we do have to mention that in our report. But if we do think it's a low bar, for example, if an Aussie equity fund, including a long short, for example, is having a cash benchmark, we do make a comment that that's a low bar and easier to achieve, therefore, especially going back a couple of years with cash at zero. And we at times, we also include a second performance table, which is not just versus the benchmark, versus our reference index, as we call it, so which might be cash +3 or cash +5, depending on how we assess the risk profile of the fund. So yes, we have those discussions externally and internally.
Great.
Okay, I think that's a wrap. Thank you, gentlemen.